President of the World Bank, David Malpass, is concerned about China's loans to developing countries and the possibility of a Chinese debt trap. China has increased its lending to developing nations at a time when concerns have been raised about the sustainable financial future of those nations. But what is China's debt trap? It refers to China's practice of offering large loans to developing countries for infrastructure development projects and its unforgiving nature when it comes to the recovery of loans. Often, these loans come with unclear terms and conditions, leaving these poor countries vulnerable to economic and political exploitation by China. As per an exclusive report by Associated Press, countries such as Kenya, Laos, Zambia, Pakistan, and Mongolia are now faced with the tough choice to keep schools running and provide electricity to the public, or pay back their debt to China. Let's look at some of the shocking statistics to understand the gravity of Chinese debt trap. Sri Lanka had to give away its Hambantota port to the Chinese government on a 99-year lease owing to its $1 billion debt. The next to follow Sri Lanka's fate are Zambia, the African nation, defaulted on loan repayment worth $6.6 billion to Chinese banks. Pakistan is also at the verge of defaulting as it owes more than $30 billion. Kenya borrowed $9.2 billion from China in the period between 2000 and 2019. Laos' total debt exposure to China is worth approximately $12.2 billion. These nations have depleted a large chunk of their foreign currency reserves in loan repayment and are now left with only a few months' worth of resources. The World Bank president, David Malpass, emphasized the need for transparency, accountability, and openness in China's lending practices.
On China, important is they are still including non-disclosure clauses in some of their contracts. That makes it very difficult to do the restructuring. They take collateral, which is not really necessary, and also escrow accounts. So these techniques of the lending techniques, I think, can be improved.
China has emerged as a prominent participant in global lending with its Belt and Road Initiative, BRI. Involves investment in more than 100 countries. However, the program has drawn worldwide criticism for using debt as an instrument of geopolitical leverage. Over the past 10 years, China's loans to low and middle-income nations have tripled, and by the end of 2020, they have reached $170 billion. The World Bank estimates that between 2000 and 2020, China's overall lending to developing nations totaled $462 billion. This outperforms traditional lenders like the World Bank and the International Monetary Fund, IMF, in terms of lending. China alone loaned poor nations $87 billion in 2020, compared to the World Bank's $28 billion and the IMF's $20 billion. It is challenging to repay Chinese debt for a number of reasons. The loans, first and foremost, have high interest rates, which can make repayment challenging for nations with already limited resources. The fact that many of the projects backed by Chinese loans are not profitable is another problem. These projects proved futile in bringing money to pay back the China's loans. Third, the collateral China demands in exchange for its loans is another aspect that makes it challenging to repay Chinese debts. Furthermore, China's financing methods lack transparency. Many nations take on loans with terms they don't fully comprehend, thus pushing them deeper in the Chinese debt trap. Despite these concerns, China is continuously offering loans to the developing countries and pushing the world's poorest countries to the brink of collapse. China needs to be stopped. But how? Is the question that world economies should come together on one platform to answer.